What's going on, everyone, and welcome back to the channel. Today, we're getting fired up about high-growth investing. Buckle up, because we're going to explore some strategies that have the potential to supercharge your portfolio. But remember, with great growth often comes great risk. So this video is definitely for those of you who have a higher risk tolerance and are looking to maximize your returns. Before we dive in, let's establish a crucial truth. There's no guaranteed path to riches in the investment world. Every strategy we discuss will involve some level of risk. However, by understanding these high-growth approaches and conducting thorough research, you can position yourself to potentially take advantage of exciting opportunities. All right, with that out of the way, let's jump into the top 5 high-growth investment strategies you need to know in 2024. Strategy 1. Embrace growth stocks. First up, we have growth stocks. These are the all-stars of the high-growth game. They're companies that are prioritized for future potential rather than current profitability. Imagine a tech startup on the verge of a breakthrough product or a company in a rapidly growing industry like renewable energy. These are the types of businesses that growth stock investors target. The allure of growth stocks is undeniable. The chance to get in on the ground floor of a company that could explode in value is incredibly tempting. However, it's important to remember that these companies are often pouring resources into research and development, which means they might not be turning a profit yet. This lack of profitability can make them more volatile than established companies. Strategy 2. Explore thematic ETFs. Exchange-traded funds, or ETFs for short, have become a popular tool for investors of all experience levels. Think of them as a basket of securities bundled together into a single tradable unit. Thematic ETFs take this concept a step further by focusing on specific trends or themes within the market. For example, you might find thematic ETFs that target cybersecurity companies, artificial intelligence firms, or even companies focused on sustainable living. Thematic ETFs offer a great way to capitalize on a hot sector without having to pick individual stocks. This allows you to diversify your portfolio while still getting exposure to a promising area of the market. Imagine being bullish on the future of artificial intelligence, but feeling overwhelmed by the number of individual AI companies to choose from. A thematic ETF focused on AI can provide a convenient and diversified way to play that trend. Strategy 3. Consider small-cap stocks. If you're looking for an even more high-growth opportunity, then small-cap stocks might be worth considering. These are stocks from smaller, younger companies with the potential for explosive growth. Think of them as the Davids to the Goliaths of the large-cap stock world. Small-cap stocks can be incredibly enticing because they offer the chance to get in on the ground floor of a company that could become the next big thing. However, it's important to remember that with great potential comes great risk. Small-cap stocks are typically much more volatile than large-cap stocks, which means their prices can fluctuate significantly. They're also more susceptible to economic downturns. Here are some pro tips for investing in small-cap stocks. Do your due diligence. Small-cap companies often fly under the radar, which means there might be less readily available information about them. This makes thorough due diligence even more critical. Research the company's financials, their leadership team, and their competitive landscape. Understand the industry they operate in and the specific challenges they face. Invest for the long term. Similar to growth stocks, small-cap stocks are best suited for a long-term investment approach. The volatility inherent in these stocks can be nerve-wracking in the short term. By holding them for several years, you give the company time to grow and mature, potentially leading to significant returns. Diversify, diversify, diversify. Don't put all your eggs in one basket. The high risk associated with small-cap stocks makes diversification even more important. Spread your investments across a variety of small-cap stocks from different industries to mitigate risk. Strategy 4. Leverage robo-advisors. If the idea of picking individual stocks or thematic ETFs makes you break out in a cold sweat, then robo-advisors might be a great option for you. Robo-advisors are automated investment platforms that use algorithms to build and manage your portfolio based on your risk tolerance and investment goals. Here's how it works. You answer a series of questions about your financial situation and investment objectives. The robo-advisor then uses this information to create a personalized investment portfolio for you. The platform will also automatically rebalance your portfolio over time to keep it aligned with your goals. Robo-advisors are a great option for beginners or those who simply don't have the time or interest in actively managing their investments. They can also be a cost-effective solution, as robo-advisors typically charge lower fees than traditional financial advisors. Here are some pro tips for using robo-advisors. Research different platforms. There are a number of robo-advisors out there, each with its own strengths and weaknesses. Research different platforms and compare their fees, investment philosophies, and account minimums before choosing one. Understand the limitations. While robo-advisors offer a convenient and automated approach to investing, they aren't perfect. They may not be suitable for complex financial situations or for those with very specific investment goals. Strategy 5. Don't forget alternative investments. We've covered some traditional investment vehicles, but let's not forget about alternative investments. These are investment options outside of the realm of stocks, bonds, and mutual funds. Some examples of alternative investments include real estate, venture capital, and private equity. Alternative investments can offer high growth potential, especially real estate, which has a long history of appreciating in value. However, they also come with a higher degree of risk and often require a larger initial investment compared to stocks or ETFs. Additionally, alternative investments can be less liquid, meaning it might be difficult to sell them quickly if you need the money. Here are some pro tips for considering alternative investments. Carefully consider your risk tolerance. Alternative investments are not for the faint of heart. They can be complex, illiquid, and involve a significant amount of risk. Before venturing into alternative investments, be honest with yourself about your risk tolerance and ability to handle potential losses. Understand your liquidity needs. Remember, alternative investments can be less liquid than traditional investments. Make sure you have a long-term investment horizon for any alternative investments you choose. Don't invest money you might need in the short term. Now that we've explored these 5 high-growth investment strategies, I'd love to hear from you. What are your favorite high-growth strategies? Have you had any success with any of these approaches? Leave a comment below and let's start a conversation. If you found this video helpful, be sure to give it a thumbs up and subscribe to the channel for more content on investing and building your wealth. Thanks for watching.